in the investing world that we need to be cognizant of and try to manage in our portfolio. Okay, top left, market timing. Yeah, everyone, that's when you move all your money out of an invested position over into cash. You know, it sounds easy. If you think the markets are going to go down, just put everything in cash, and then when it bottoms, buy back in. Well, if it was that easy, everybody would do it, and everybody would be, you know, retired on an island. But it's not. And so we believe in an asset allocation approach as opposed to market timing. Currency risk. We talked about, you know, the long-term potential weakness in the value of the dollar. So it's wise to diversify some outside of dollar-denominated investments. Political and economic risk. You know, they're seeing this over in Greece right now. You know, they've overspent for years there, and I read yesterday that Greek bonds may have to be revalued. S&P is saying that 70% of the principal could be written down on Greek debt. So we always have to be cognizant of what the politicians are doing and what the general economic situation is. Liquidity. Liquidity risk means how easy is it to convert your investment into cash? You know, with marketable securities, it's easy. With something like annuities, which I don't believe in, it's tough. Limited partnerships, no liquidity. Direct real estate, very non-liquid. So there, you know, if you need to have the ability to convert your investments into cash, liquidity risk is important. Call or reinvestment risk. How many in the room own municipal bonds or municipal bond funds? Okay, a few. So you may know that bonds can be called in by their issuer before the maturity date, and this is very prominent with muni bonds, and you get all your principal back. So this nice coupon, this maybe 4 or 5% interest you've been earning, all of a sudden goes away and you get your money back, and then you go to reinvest at today's rates, and it's sticker shock. Interest rate risk refers to the price of existing bonds and what happens to them if interest rates go up. And we'll talk more about that in a little bit. Market risk, that's general market risk. Industry or company risk. You know, this has been something that has dogged the financial industry lately. The Dodd-Frank Act that came down last year that is trying to, you know, take care of banks and restrict their activities. That has brought some risk on that industry. The healthcare industry with the big Obama healthcare legislation. Government interference can really bring on specific risks to an industry. Credit risk. Credit risk is the risk of default. All right? So you always need to, before you invest, think about, you know, how strong is the person that I'm giving my money to, the institution, the issuer, and what is the credit risk. And then lastly, inflation. Right now it's low. Anyone know what inflation has averaged?
3%?
Since the mid-20s till today?
About 3%.
About 3%, right. Right now we're running between 1 and 2. It has not been a problem in recent years, but we'll look at a slide later to show you that it's like the silent, you know, destroyer of wealth in a person's portfolio. And you have to have some type of hedge in your portfolio to help combat the effects of inflation. Okay, so for fixed income securities, these are the main areas that we're going to go over today. cash and cash equivalents, which are the safe areas. That's where your principal will not decline, where your principal is fixed. All right? Then we're going to talk about bonds. We're going to talk about individual bonds, individual issues. We're going to spend a couple minutes on preferred stocks, which really act like long-term bonds. And then we're going to talk about different managed bond vehicles. Bond funds, which like traditional open-end funds, closed-end funds, and then also ETFs. And I'll give you some examples on those. Okay, for cash and equivalents, again, the highest safety. Treasury bills are the risk-free benchmark of the world. Even though the dollar has been under pressure, the treasuries, U.S. Treasury securities, are still considered the safest securities in the world. And T-bills, being short-term, direct obligations of the U.S. government, are the risk-free benchmark. But you look at the yields today, and T-bills are issued in different maturities up to 1 year. You can get 0.34% on a 1-year Treasury bill. There's a price to be paid for safety. When we had the big problems in '08, there was this huge flight to safety, and the Fed brought interest rates down to near zero, and that's where they've stayed. And in the last announcement after the Fed meeting a couple weeks ago, Mr. Bernanke stated that they intend to keep rates at this low level for an extended period of time. Goldman Sachs is saying they don't see the Fed raising rates until after 2012. So it's presented a real problem for savers that have traditionally kept money in Treasury bills, in bank CDs, because if CDs are coming due these days, you know, you go to renew and it's like, you got to be kidding me. So we're going to look at some good alternatives for you. Bank account, CDs, money market mutual funds. How many in the room have a brokerage account with a discount broker like a Fidelity, Schwab, or TD Ameritrade? Okay, a lot of people. Great. You know, that's the smart way to manage your money. I mean, if you have an advisor, then you've got a brokerage account there. You know, your money market mutual fund is part of that account. That's your cash. That's your safety valve. It's always wise to keep a certain amount of your portfolio in cash. You know, 5 to 10% is a good rule of thumb. To put the interest rates of today into perspective, this shows since 1954 what the average has been. Like the Fed funds rate, this is the short-term rate for overnight bank lending that the Fed controls. All right? It's averaged 5.4 over this time period. Right now, it's 0 to 0.25. All right? 1-year treasuries have averaged 5.5. As we said, right now, they're 0.34. Intermediate governments, that's a 5-year right there, 6. Now they're down. I saw the 5-year Treasury yield today, 1.9. Long-term governments, that's a 20-year yield. The average is about 6.6. Right now, you're about 4.25 on a long-term Treasury. So way, way, way below average. But a lot of people are surprised that interest rates have stayed down this long. You know, until the economy can generate enough strength, until we get consumer spending back up, and confidence back up, jobs, hiring, incomes back up, we're going to be, I think, confined to this low interest rate world. So, again, the Fed is in no hurry to raise rates because the housing market needs rates to stay low in order to start to generate, some type of activity. So, if we move out of the cash realm, then we get into bonds. So we're going from no risk to low risk with these fixed income securities. And a bond is nothing more than an IOU. We give our money to an institution and they give us a bond that's simply a promise to repay at a certain date, which is the maturity date, with interest. It's that simple. All right, these are the 5 main types of bonds that we can choose from out there in the marketplace. Number 1, U.S. governments. So the bills are short-term. Then we have notes, which are intermediate term, and bonds, treasury bonds, which are long-term. And as we see here, the 10-year treasury yield is 3.19 right now. Again, that's another benchmark yield that all bonds price off of. Because again, treasuries are considered to have no credit risk, AAA rated, and so that's just where things price off of.
Scott, do you have any U.S. government bonds long-term in your client's portfolio?
We have very limited exposure there right now. We did take a position in TLT, an exchange-traded fund, which owns long bonds, a couple months ago when rates had shot way up. And if you look back at 2008, when the stock market and basically all asset classes were crushed, what made money in 2008? Treasuries. Treasuries and gold. So there's a safety factor in treasuries, and the belief in our firm is that we're in a long-term bottoming process with interest rates that could take several quarters, and so we're looking at this as a short-term, more tactical play as opposed to a long-term hold, and so far.
So you have a small amount.
Small amount. Yes.
And when you say small, does that mean 5–10%?
No, like 2.5.
2.5. Okay.
Yeah. How about TIPS? Anyone here have TIPS? TIPS are Treasury inflation protected securities. They have a nice ring to them. The government came out with them a little over 10 years ago, and they basically have done nothing but go up in price since then. And so they are very overvalued at this point in time. And you can get a 10-year tip today, and you get 0.65% for your yield. Okay? But the thing is, so you say, well, why wouldn't I want to just buy a regular straight treasury and get over 3%? Well, because with the tip, your principal increases by inflation. So it's a good inflation hedge, but one of the problems is that the CPI doesn't capture all of the inflation that you and I experience. So I would not touch tips at all today. All tips right now are trading at premiums.
So you pay more. Okay.
So they're issued at par. Okay. But they have all gone to premiums.
Okay.
So prices are way up, yields are way down. It's dangerous, very dangerous now.
Okay.
The government, what I would do is I would keep an eye on the government auctions. The Treasury auctions new tips periodically, and you can, watch that, monitor that, and if we've gone through a period where bond prices have come down and yields have gone up, then that's when you want to get interested.